Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, Dodge. The yuan steadied on Friday. It halted a 3-day slide after last week's devaluation. Are you expecting more volatility to come this week?
Well, good morning, Melissa. Yes, I do, not only for this week, but over the next short-term period, 6 weeks to over 2 months. I mean, there's a lot going on now, not just in the fact that they are beginning a real process of normalizing the Chinese yuan relative to other rates, but there were devastating explosions in Tianjin that presented the Chinese government with a difficult environment and political cleanup operation. I mean, their chemicals were 70 times over the allowed limit. China is known for its knockoffs. There was one of the world's largest banks. The China Construction Bank was the latest victim. They had an elaborate fake branch that was set up. So there's a lot that the government is going to have to deal with over the short term, not just the Chinese yuan. So I do expect some volatility as the world gets used to the new reality of what's happening, as well as the Chinese government having to deal with how to bring the yuan back into normalcy relative to the rest of the world.
Well, taking all those things that you said into consideration, Dodge, the PBOC says it has no intention and sees no need, in fact, to be involved in a currency war, and in fact reckons the driver of future economic recovery will come from domestic consumption within China. Do we have any reason to believe that, to take them seriously?
Well, actually, yes, because that is a fact. What will really create the resolution to this is growth, economic growth, internal economic growth. And so that will be the China has to get to that point. It's going to take time. It's not going to be short term. What China is saying is true, but to get there, they're going to have to be very masterful in supporting and then letting the Chinese yuan devalue. And that's going to be the risk. And they're playing against a lot of very smart players in the foreign exchange market. So over time, it was very similar for us converting from low interest rates to regular market over here. It takes time, and the transition is what's going to be important. If the Chinese government can smooth the transition out until their economic growth comes back, then yes, everything will be fine, and what they're saying is true. The problem is it's going to take time, and there are going to be some real rough edges, and they're playing against a lot of very smart people who are playing in the foreign exchange market. Yes, they're big. Yes, they're very smart. But between now and when economic growth resumes again, that's a time period where there's going to be a lot of volatility, and that will take time.
Dodge, you mentioned earlier that investors have now had some time to adjust to this new reality coming out of China with yuan, and what that might mean for them in the short term and the long term. What's your take? Has that changed the way you do business?
Yeah, yes, it is, and this is what we're watching. Economic growth has been at the center of Chinese politics. The fixed exchange rate was adopted to promote growth, and it really did work because there was an economic fundamental that is usually not taken into account, and that is faster or improving, accelerating industrialization, which was particularly important for China, who had much more catching up to do than most nations. So the fixed exchange rate had created favorable terms of trade for exports and really helped the industrial sector grow. You look at the 7 years beginning in 2001, their export volume increased 5 times and accounted for 40% of their overall growth. So at that point, it was really working. But Melissa, it came at a very heavy price because the Chinese were forced to accumulate $3.7 trillion of foreign reserves, which is larger than the gross domestic product of Germany, which is the 4th largest economy in the world. These reserves were invested in relatively safe assets, earning less than 3%, while the rate of return for capital in China was more than 10%. So that 7% gap created an average loss of 2.5% of their GDP, and that's what they have to make up for now. Clearly, China is on its way to rebalancing, and at a time when, after 15 years of expansion, China is losing the economic fundamentals that supported the fixed exchange rate. So we are at that point where it makes sense to drop the fixed exchange rate and to convert. Mm-hmm. Also, it's happening at a time when the renminbi's bid is to join the International Monetary Fund special drawing rights creates another reason to allow it to fluctuate and not be fixed. But it's going to take time. And what is going to happen in between now and when their economy grows, Melissa, is going to be a lot of volatility in the markets, particularly foreign exchange. Mm-hmm. It won't be one way. China will have to support and will not be able to allow the renminbi just to drop continuously. There will be fluctuations in order to avoid that foreign currency, that exchange war that could possibly happen. So what we're doing is now we're much more on guard. We're much more aware of what's happening, and we're over on the other side of the world, and we're not directly affected by it, but boy, we sure are directly affected by it because of what it's doing at the markets that we're relying on. So yes, we're very much more aware of what's going on, and we are much more short-term oriented until this volatility and the perceived volatility is able to work itself through. And what we're guiding ourselves to is to watch economic growth return to China, and that will be the time when things will start to smooth out again.
Yeah, for sure, Dodge. I think everyone's going to be watching China a lot closer and be a lot more agile in reacting to any moves coming up from China. But if we could zoom out and look at oil prices, Dodge, what's your view on oil prices in terms of this perceived oversupply and in terms of global demand, given that I think there's currently polarized opinions on its price bottom?
Yes, and this is really very, very interesting because the oil market right now is signaling that prices could stay lower for much longer. The benchmark U.S. futures for September delivery are nearing the 6-year low hit in March, but contracts for delivery in later years have taken an even bigger hit, with prices in 2016 and 17 already trading below their March lows. So that indicates that investors and traders and oil companies all see the global glut of crude oil persisting beyond this year. Now, what is happening, what we're beginning to see happen, is that oil companies both here and in other countries perceive this, Melissa, and want to sell. They are not restricting their production, and they want to get it out there because they are more concerned over the longer-term future of oil prices. So at one point, on one hand, you see that oil prices are going down. On the other hand, you see oil companies wanting, rather than to restrict supply, they want to get the supply out now because they're concerned it's going to go down even further. The oil companies are in real risk now, and to turn off the oil fields, Melissa, costs even more, much more than continuing to produce even at a lower rate. So the economics do not allow the rational decisions to be made by the oil companies, which would be to shut down their rigs. And we are seeing that rig growth is still growing. Yes, it's at a slower pace, but all this is adding to the glut of oil that we see now. Ultimately, oil companies will have to, over the long term, come to grips with this, and their management styles will have to come up with all other alternatives. Also, it's going to affect shale. So right now, we do see a glut. We do see some additional glut coming onto the market. We see that oil prices are going to stay down, and it does adjust the rest of our economy.
Right, so a continued downtrend on oil prices likely, Dodge?
Yes, okay. Yes, at least for the next 6 months.
And just looking at the week ahead, Dodge, the Federal Reserve is set to release minutes from its July policy meeting on Wednesday. Are you watching out for anything in particular that could change the market view of a September rate hike?
Yes, two things. One, details about how much improvement in the labor market is needed before an increase in interest rates, and two, any discussion about inflation. Those will be the two drivers that will help improve our perception of whether there's going to be a September rate hike or not.
Okay, great. We'll keep an eye on that data. Thanks so much for speaking with us today. That was Dorland, Chairman and Chief Investment Officer of Landor Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6.